So today we're talking about estate planning and a way to use life insurance to lower your estate tax bill or perhaps pay your estate tax bill. You do this for your family, and you can set up an irrevocable life insurance trust. And the acronym for that is an ILIT. So that people are talking acronyms in our business, they refer to an ILIT, and most of the people in the room know what they're talking about. But with consumers, people are what? And so that's a trust. And you kind of, the way the guy taught it to me years ago was, okay, so your estate is here, and then way over here is this trust that's completely separate that owns the life insurance. So it's a way to create separation for the life insurance policy and the proceeds, so that there will be money that'll show up that's not going to be taxed. It's not going to have an estate tax. It's not going to have an income tax. And it creates liquidity just when it's needed to pay estate taxes or to pay money to your heirs. So the purpose of the video today is to teach you about an ILIT and what it's used for. And we're going to talk a little bit about life insurance, but it's mostly the ILIT today. And what I want to do is bring Tom on, and I want Tom to talk about why are we doing this? What compels us to talk about this today?
We're doing this video because in the current law, the estate tax exclusion is getting cut in half in 2026. And so right now, a lot of people aren't worried about estate taxes. The exclusion is $13 million roughly. When that starts getting cut in half, more and more people are going to be impacted by estate taxes. And so we just want to do some planning around how do we help either pay the tax, maybe all of it, or have the kids pay less of it, just to have more of your wealth passed to the next generation, which was your intention all along. One of the things that I want to bring up where this is especially important for is if you have someone who has just money in investments, maybe cash that this has this much wealth, the kids are going to be able to pay the estate tax out of the money. It's not efficient, it's not ideal, but they would be able to pay it. Where this is really problematic is if you have someone who's inheriting like a small business, maybe a family farm or a lot of land. Now liquidity becomes a real problem as they have this asset that's not real liquid. It's part of the estate. They have to pay estate taxes on this value. The only way they can get the money out of it potentially might be to sell it, which is really not what you want. And so this is a great way to create liquidity when it's needed to help cover those estate taxes once they're eventually owed. And so I want to bring up the show notes here. We have the picture of the board. You can find these at the link below our video. They're also on our website. We have the board here. We have more sort of detailed instructions of how the ILIT works, what is needed to do it. I'm not going to go through them in detail right now, but if you want to read more about it, we got them here. We have the IRS tax codes tied to it. So if you really want to go look up all this stuff, go for it. Not great reading, but hey, if you're interested, there it is. I do want to just make one other point is when you're doing this, you really need to make sure you follow all the steps properly. Don't try to do this on your own because if done wrong, now the life insurance proceeds become part of the estate anyways, and you've just made the problem worse. So Hans will talk a little bit more about the steps that need to be taken. You need to make sure it's done right, and you consult a professional if you're wanting to go through this to make sure it's done properly.
Yeah, somebody that's handled these before, an attorney and a trustee that has experience with them, maybe that manages a bunch of them. Because when people get in their older years, sometimes they mess these things up. They start giving the money directly to the kids, or they just think that life insurance isn't going to be worth anything anyhow. And so there's things that happen down the road that need to be prevented. And a good trustee who's on top of it, and a good life insurance agent, financial planner like Tom and me. Unfortunately, I probably won't be around when these problems are happening, but Tom probably will be, or some of our other young folks. So let's talk about an ILIT and what it is. It's a trust that is funded primarily by life insurance. So it's best with these things if the trust is created, the life insurance policy, those are created at the same time. So there's no value. Maybe you throw $1,000 or something into the trust, or 2,000 or something, to just have a base amount of money, and then um, when you make the first gift to pay premiums is when the life insurance will begin to accumulate some money. So what we're trying to do here is set up a trust that's going to remain out of your estate. It's not going to count after you pass, and it's going to create immediate liquidity. So the trust cannot, after it's created, it can't be modified, amended, or revoked without permission of the beneficiaries. Now, some people say, what do you mean? I got to go ask my kids if I want to change this when I'm giving them the money for this thing in the first place? Yeah, that's about how it works. So some of you, this isn't necessarily what you want to do, okay? And there's alternatives to this, but this is a way, like if you own a small business or a medium-sized business and a lot of your wealth is tied up in the business, and then your kids work in the business, your grandkids work in the business, maybe it's a farm, and you don't have a lot of cash laying around, it has a large value, you don't want them to sell it, this thing is perfect, okay? I mean, I shouldn't say perfect, but it's something you ought to seriously consider, is setting up an ILIT and then buying life insurance, okay? So you can't modify it once it's set up. That's the irrevocable part. If it's successful, it removes the proceeds of the life insurance from your gross estate. So, if you think about somebody that has a business or some land or a farm that's worth millions, and that makes up a good portion of their estate, and then if they die and it's passed on to the kids, right when they die, there's an estate tax that's due, and the thresholds are coming down in 2026. So then, wouldn't it be nice to have a life insurance policy that is separate from your estate that provides them the money to pay the estate taxes so they can keep right on trucking, owning and running the business? Now, if you don't set up one of these and it's included in your estate, and let's just say the life insurance policy was $5 million, then now your estate is $5 million larger than it otherwise was. And so sure, you get $5 million of cash, but you got to pay estate taxes on that $5 million at 40 after 2026, 45%. So there's good reason to set these up. And there's some real fragile laws around gifting, around the trustee, around control over. So all I'm doing is going through some of them that that you need to follow and you need to think about before you even consider these things. Now, in 2024, the maximum gift that you can give tax-free to anyone, really any person, but we're thinking about family here and the beneficiaries of the trust and of the life insurance, is $18,000 a year. But if you think about that, if you're a couple, husband and wife, you got $36,000 a year that you can give to any one person. And if you got two kids, that's $72,000 a year. And if your two kids have spouses, that's $144,000 a year. So there's a way to aggregate these things to come up with as much premium as is necessary to pay the premium on the life insurance. So the life insurance is done through gifting, but if you actually just pay the premium on the life insurance, just send it directly. This is one of the places that people make mistakes in later years. That creates an incidence of ownership. So you run the risk, if you start paying the premium, forget the trust, straight through to the life insurance company, then that whole death benefit is going to be included in your estate. So it's necessary to go through the procedures and do the gifting. Now, if you just give the money to the kids and say, hey, pay the premium, that may or may not happen. A lot of people don't want to give money to their kids at their current age, thinking the kids are going to run and spend it. So there's a way to give it to them, send it to the trust, the trustee, and then there's this thing called crummy powers and a crummy letter, and that was a person's name that fought the IRS, or their estate fought the IRS way back when. And so if you send the money to the trustee, the gift, and then the trustee sends a letter to the kid that was receiving the gift, is an adult now, and they're receiving the gift, they have 30 days to go claim the gift. If they don't claim it in 30 days, they then it's a legal proper gift, and then the trustee is going to send the money to the life insurance company to pay the premium. So that all pulled off, and you need to have a conversation with your kids, and the trustee needs to do that on an ongoing basis about them going and claiming that money, that it could mess things up. So, but it makes it a complete gift. And this ILIT, or Individual Life Insurance Trust, or Irrevocable Life Insurance Trust, is primarily used to pay estate taxes and to create cash liquidity for an estate, and to do it income tax free and estate tax free, because you run the risk when you buy a bunch of life insurance that just further runs up the value of your estate. So I want to bring Tom back on. I'm sure he has a couple more comments.
Yeah, I mean, I think what like Han said at the beginning of the video, this is done the best when you set these up as part of a larger plan, kind of at the same time, right? There is a way to gift a life insurance policy into the trust. It gets a little bit complicated if you're trying to do this after the fact. So I don't want to get too far into those details today. But if you're sitting here looking at your estate, looking at the exclusion going down in 2026, sort of projecting the value of this growing, right? Hopefully your estate is growing between now and when you eventually pass away, and you're looking at this might be a problem. This is a great way to have money that create, or have a policy, a life insurance policy that creates the liquidity that your kids need to pay those estate taxes. And when using this ILIT, we can have that value pass outside the estate. And so that's really the purpose of this. Every policy is going to be different. Sometimes we'll buy a second to die policy on a couple, because the estate tax doesn't really come into play until the second spouse passes away. That's a little bit less of an expensive life insurance policy. And so there's all sorts of things that we can do to set this up. But it's a wonderful way to do it. It does require that you qualify from a health standpoint for a life insurance policy. So you need to do this while you can still go through underwriting. So, if you've had something happen, you're sick, that doesn't always mean that you'll be declined, but there are certain sicknesses that will prevent you from buying any life insurance policy. And so that's something you need to do, have some forethought to be able to plan for, your kids. Really, and like Han said in the beginning, you're doing this for your family, right? Sort of by definition, you'll have died when all this is being played out, but it's really going to set your kids up in a way to really receive all your hard-earned money and your assets going to them without the IRS coming in and taking a big chunk of that out.
Well, sure. And Tom brings up a good point here. A lot of these, when we're dealing with a couple, we're going to offer you a survivorship policy. It doesn't pay off till the second death. And they're much less expensive, and they're a bit more forgiving in underwriting if one of the spouses has some health problems, the other one's in good health. The insurance company is going to take that into consideration. Some of these we sell single policies because the people are single now. So don't assume that you won't qualify. We can talk to you about the life insurance, and we've got a whole variety of companies to offer that through. So I want to bring Tom back on, and I just want to show that what we talked about in the 7 worries today is estate planning and taxes. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening to us.
Thank you.